Good evening, everyone. This is Sony Patnaik from HDFC Securities. Welcome to one of our derivative webinar series. So today's topic for the session would be options trading. So we'll try to understand more on writing versus buying of options. What are its pros and cons of options? Which strategy should you opt for, whether be it options buying or options writing? And we'll also have a lot of views today from market experts, from a lot of novices to understand exactly what would they offer or what would they prefer and opt for, whether to go for options writing or options buying. And what kind of a strategy is best suited in what kind of a market. That's all that we would be covering in today's webinar series. So over to my screen. Right, so we are going to understand what strategy to go for, whether to buy or write. But before we get into all these serious strategies, we'll first take a quick understanding of what options is all about. So we'll just have a quick recap of the options and the understanding, basic understanding of a buyer versus a seller in options. Now, as we know that in derivatives, we can always create two kinds of position. One can be on the buying side and one can be on the selling side. It stands true for the futures as well as in options. So in options also you have a buyer and you have a seller. So we'll understand which or who has the right but not the obligation whether to buy or sell the underlying asset at a certain price at or before expiry. So this is what options is. Now let us understand quickly what this option buyer and option seller is trying to tell us. So when you're buying of options, buyer of options, you basically pay premium. Hence, the premium that you have paid, your loss is limited only to the extent of that premium that you have paid, whereas your profit can be unlimited. This is in case of options buying. When you are the seller or writer of options, you receive a premium. And in this case, your risk or your loss is unlimited, whereas your profit is only limited. So options buying, you pay premium. Options selling, you receive a premium. The risk and reward ratio is different for both cases, be it options buying or options selling. Now, as we know that there are two kinds of options, one is a call option and one is a put option, right? So the call option or the put option, you can create both positions. You can be a buyer or you can be a seller depending on the view. But before we get into those view, let us understand what exactly the buyer and the seller of call and put option means. So when I say you are the buyer of a call option, it means that you have the right but not the obligation. You just have the right over here to buy that underlying stock at a certain price. It means that you have the right to demand from the seller that you can you can buy that stock at a certain price at or before expiration. But when you are seller of the call option, you would have the obligation. Here you do not have the right, but you're directly obligated to sell that stock at the certain price, and you have to fulfill this obligation if it has been demanded by the buyer. So this is the seller and buyer of call options. For a put option, the buyer would have the right to sell the stock at a certain price. Because a put option buyer is usually bearish in nature or in view, that's the reason why a put option buyer would have the right but not the obligation and would have to sell that stock at a certain price. Whereas the put option seller would have the obligation to buy the certain stock at a certain price at or before expiration. So this is what buyer and sellers of call and put options they usually mean. You can have this more clear when we understand what kind of view it holds when it comes to call and put option. That would give this definition a little more clarity. So this is what we have. So there can be only two kinds of view. You can have a bullish view or you can have a bearish view. So when you have a bullish view, you buy a call option or you sell a put option. When you have a bearish view, you can either sell a call option or you can buy a put option. So this is how your call and put options, they differ in terms of view. To get this more clarification, get more clarification out of this, there is this quadrant that you can see, and we'll try to understand how this quadrant explains us the concept of call and put option, whether it's a buyer and seller. Now you can see that the X quadrants that we have the X quadrant is a call and put, and the Y quadrant is of buy and sell. So when you are buying a call option, you expect that the price of the stock will rise. That is the reason why you're buying a call option. When you're buying a put option, that you can see the put option on the X quadrant and the buy option on the Y quadrant. When you're buying a put option, you are expecting that the price would fall. That's the reason why you're buying a put option. Now, the opposite of buying would be sell. So when you sell a call option, you either expect that the stock should not cross that level, or you expect that the stock would fall from there. But whatever happens, it must not cross that strike level that you have written or freshly sold. So this is how for call sellers can work out. For a put option seller, you would expect that the price would either remain the same, that is above the strike price that you have written, or the stock must at least rise. So this is how a put option seller can gain out of a view. So in short, this quadrant clarifies the 4 activities that you can do when it comes to options. If you have a bullish view, you buy a call option or you sell a put option. You have a bearish view, you sell a call option or you'll buy a put option. So these are the 4 very basic activities or very basic steps or basic views that you can take in options and trade. So this we have, if you want to understand a little more of details into what options is, what call option, what put option is, we have covered these in details in our previous webinars of decoding derivatives. You can certainly go back to the YouTube channel and again, rewatch those YouTube webinars to understand a little more of the basic concepts of what call and put option. However, today's topic is to understand the writing versus buying on options trading. So we'll proceed to that main point right now. First, we'll understand some pros and cons of buying versus writing. So first, we'll understand the pros and cons of what happens when you have options buying. As we know, when you're buying options, you have a limited risk and a huge profit potential, that is unlimited profit. So your options buying, you are paying the premium, so your risk is limited only to that premium you have paid. However, if the stock moves in the direction of the option you have bought, your profit can be unlimited. So there's this chance of huge profit potential. As we know that in case of options buying, there is absolutely no margin required, because when you're buying options, your margin is only the premium that you have paid. So that is all about options buying. So the pros. However, there are certain cons that are attached to buying options. One would be time decay. Usually when we know that the options premium, they have the tendency to decay as we approach expiry. All the options premium will start decaying the sooner we start approaching expiry. So when you are a buyer of the options and you have bought at a very higher premium, your stock is not moving in your direction, there is a chance that you would start to see immediate losses from your position because of the time decay factor in options buying. And the second con of options buying is that you require very huge movement in the desired direction. So if you are a call option buyer, you would require the market or the stock to move up. Or if you're a put option buyer, you would require the stock to move down. So in either cases, when you're buying options, you require huge movement to come in. And the moment you do not see that movement coming in, your premiums start to decay, especially when you are a buyer of very deep out of the money contracts. In those cases, you would see the premiums decaying much quicker than at the money or in the money contracts. Now let us understand the pros and cons of writing options. Now when you're writing options, you have a positive time decay over here, because traders, they believe writing options of very deep out of the money contracts and they are simply playing for that time decay. They're simply playing for the mere fact that the premiums must start to decay sooner and sooner the moment we start approaching expiry. So traders or writers who get into options writing, they are playing for this time decay, the premiums to reduce the sooner we start approaching expiry. When you're writing options, you do not require a particular trend. Like I said, when you're writing options, you would expect that the stock must not increase or fall beyond that strike price. That's a reason it's a non-directional trading. And options writing is very famous when you are doing it when you're writing options against your portfolio. Supposedly you have an idle portfolio, you can write very deep out of the money options to boost or get some extra returns out of your idly lying portfolio. So these kind of strategies are called covered strategies. So a lot of traders, a lot of hedgers, they believe in writing options on their idle portfolios to gain an extra income out of it that can boost the returns of the portfolio. So options writing is very famous and popular for such kind of the market participants. The cons of options writing, obviously we know that the income is capped to this sense, because when you're writing or selling options, you are receiving that premium and your profit is only limited to that premium that you have received. So this is the reason why this is the biggest con of your options writing. Your income or your gain is capped. Needless to say, options writing is quite a risky strategy. And because it's a risky strategy where your loss is unlimited, you also have a margin required. So in case of buying of options, your margin was only limited to how much premium you have paid. But when it comes to options writing, your margin would be almost equal to the margin that is required to trade in futures, because you have unlimited loss associated with options writing. That's the reason a margin is required, which is almost very similar to the futures margin. And the third con of options writing is it has unlimited risk against limited gain. So options writing, your premium received, whatever premium you have received, that would be your maximum profit or gain. Whereas your risk is unlimited if the stock starts moving in the opposite direction of your view. So these are the very basic understanding of knowing the pros and cons of options buying versus writing. Moving on, so we'll just quickly understand, in example ways, we'll just understand how a call option buy and a call option sell works. So supposedly we say you are bullish on, hypothetical example, you're bullish on Nifty, and the current price of Nifty is 11,000. So you're buying a call option of Nifty of 11,250 call option, and the premium that you are paying for this strike is 4 rupees. Your outlook over here is that you're expecting it's moderately bullish. You can say you're quite bullish, and you're expecting that Nifty must close anytime above 250, 11,250 on the day of expiry at least. How would you calculate your break-even point? That would be your strike price plus the premium. That is 11,250 plus 4. It comes out to be 11,254. So the moment Nifty expires above 11,254, your profits will start coming in. And this break-even point is calculated as per expiry level. Let us see your risk. Your risk would be only limited to that premium that you have paid, right? So premium that you have paid is only 4 rupees. So your risk doesn't matter. Even if Nifty falls down to 10,000 tomorrow, your risk would only be that 4 rupees that you have paid. However, your profit would be unlimited depending on the price or the upward movement of the underlying. So if Nifty starts to move very high up, your profits will be unlimited. Let us see the payoff diagram of this, how it looks. Here it is. As you can see, the green is showing you the unlimited profit, and the red that you can see is giving you the limited loss. So this is the kind of strategy we have for call option, a simply call option buy. Now let us see different scenario analysis of how or what you would gain or lose in this call option buying strategy. So we have a possible values of spot. I have taken some hypothetical examples. If Nifty were to expire at these levels, what would be your profit and loss accordingly? So let's say the Nifty is expiring at 11,000, the premium remains the same. You have paid 4 rupees already. We'll have to find out the intrinsic value first. Now let us remember again, we'll refresh our memory. Intrinsic value only exists for in the money options. They do not exist for out of the money nor at the money options. So intrinsic value exists only for in the money options. Now our strike price that we have chosen for this option, for this strategy is 11,250 call. This spot is 11,000. Since 11,000 is less than 11,250, it becomes out of the money option. Since it is out of the money option, your intrinsic value is 0. What would your P&L be? It would be your intrinsic value plus the premium that you have paid. Intrinsic value is 0 plus the premium that you have paid. Because you have paid that premium, so you have to calculate it as -4. So 0 plus minus -4 comes out to be -4. So your loss remains -4 at all points. Similar is the case for 11,100. Even 11,100 as a spot is less, is lower than 11,250. Hence your intrinsic value is 0. Your loss is again just 4 rupees. Similar, you keep on going. 11,200 again only 4 rupees. 11,250 only again 4 rupees. Now 11,300. Now when you come to 11,300, the spot now is higher than the strike price. Your strike is 11,250. Your spot is higher. In this case, your strike becomes in the money. When it becomes in the money, you would start getting intrinsic value. How? The spot minus the strike price. 11,300 minus 11,250, that's 50 rupees. 50 is your intrinsic value. What would your P&L be? Because you've already paid 4 rupees and you're getting 50 rupees, so you just have to subtract it. So your profit would be 46 rupees. Similar, if the Nifty goes and expires at 11,400, so you'll just have to subtract 11,400 minus the strike. You'll get 150. That's your intrinsic value, and your profit would be 150 minus the premium that you have paid, 146. So this is how a scenario analysis works for a call option buy. Now let us quickly see how the scenario analysis works for a call option selling. Now here I've taken a screenshot from one of our advanced trading platforms called Pro Terminal, and I'm just trying to show you from where I've picked up the real-time data, the real-time premium, just to give you the example of how this real-time data or how this real-time strategy can work. So as you can see from the screenshot, I have taken Nifty, I have taken the current expiry, and I've chosen a 11,200 call option. You can see this is a strike. The yellowish arrow that you can see, that's all your strike. And here the right hand side yellow that you can see, it's pointing at 9.45. So 9.45 is the premium. LTP is your premium. So here I am choosing to sell or write 11,200 call option at 9 rupees 45 paise. Now let us see what would happen if I am writing this option. Again, you can see the scenario analysis. There are various possible values I've taken to find out what my profit or loss would be at all times. Now let us remember, since this is options writing, I am receiving the premium. Hence, for all possible values of the spot, I will consider the premium that I've received as a positive for me, because I'm receiving that premium. Right, so the first would be 10,050. If Nifty expires at 10,050, what would my intrinsic value be? Again, same intrinsic value. We'll have to understand if the spot is higher or lower than my strike. My strike is 11,200. So obviously 10,050 is less than 11,200. So intrinsic value is 0. To understand the P&L over here, there we were adding IV plus premium. Here we would deduct or subtract premium minus IV. So 9.45 minus 0. Because I'm receiving this 9 rupees 45 paise as a premium, so this becomes my profit. Similarly, when Nifty expires at 11,100, the intrinsic value is 0. I'm receiving 9 rupees. So similar, you keep on understanding where your spot is higher or lower than the strike that you have bought or sold, and you'll find out the intrinsic value. Right, now let us see what happens when the Nifty expires at 11,300. Now when Nifty goes to 11,300, the strike that I have written over here, that is 11,200, it becomes in the money for me. Moment it becomes in the money for me, I'll have the intrinsic value. How the intrinsic value will work? The 11,300, the spot minus the strike that I have sold. Hence, intrinsic value is 100. Now I have received 9 rupees already. So my loss would be 9 minus 100, that is 90 rupees 55 paise. I would lose if Nifty were to expire at 11,300. Similarly, if Nifty expires at 11,400, the premium that I've already received is 9 rupees. My intrinsic value would be spot minus the strike price, that is 200. So 9.45 is the premium that I've received minus this intrinsic value, that is 200. So if Nifty were to expire at 11,400, my loss would be 190.55. So this is the difference between options buying and options writing, and how various scenarios will work in case of either of these strategies, be it buying or be it selling. So with respect to options buying, just let us understand, when you're buying the option, when you have a bullish movement, you buy a call option. When you have a bearish movement, you buy a put option. So you buy an option, be it a call or a put, only when you're expecting a moderate to significant directional movement to come in the stock. When you do not have this directional movement in the stock, you should not exactly go for buying of options. Now, also we have covered volatility skew in earlier webinar session. I'll just rephrase it very quickly. Volatility skew is nothing but it will tell you if the options are very expensive or less expensive to buy. So usually that's something that is covered by option volatility skew. And when you see that there is not much of volatility, there is a lot of volatility skew, you pay a higher price for the premium. But if there is not much of the volatility skew, you pay a fair price of the premium. So it is very important to understand how much premium you are paying and how many days are left for expiry. If you're a buyer of options, that too if you're in the early days of the expiry and the movement is not coming in your desired direction, it is better that you take your losses and cut down your losses and square off your position. Because if you are waiting for 2 weeks into the expiry and you have bought a very deep out of the money option contract and you are seeing that the stock is not moving in your desired direction, you would start to lose out on the premiums. So that would give you losses, because as you approach expiry, premiums will decay further. Sorry, and then as we'll understand, with respect to option buying, there's always a limited risk but an unlimited profit. Now let us understand the same with respect to option selling or options writing. When you write or sell any option, if you're writing call option, you have a bearish movement. If you're writing a put option, you have a bullish movement. So when you write options, you believe that upon expiry, the underlying asset must not go beyond that strike price that you have chosen to sell or write. This is the basic funda of understanding why one must go for options writing. The level should not break. That's the reason why one goes for options writing. So when premiums are very high, when volatility is very high, your premiums would be high. And especially when you see that deep out of the money contracts have very high premiums, it can be quite ideal for options writing. Because when you're writing deep out of the money options contract, for the stock to cross that level, it might take a lot of time. So you can play upon that time, which can factor in for your advantage, because the premiums will slowly and steadily start to decay. So you play for the positive time decay over here. And if you're a writer or seller of the options in the early days of expiry itself, and you're seeing that your strategy is not going according to your view, it is very advisable that you cut down your position, follow a strict stop loss, because we must remember that whenever we are writing single naked options, Your profit is limited only to the extent that you have received the premium, but your risk or your loss is unlimited. So hence, if you're only doing naked options writing, it can and the stock is not moving according to your desired direction, it is better to cut down on the losses instead of waiting for that unlimited loss to kick in. However, if you are writing these options against portfolio, you are doing some covered strategies, that case it would be a little different scenario. You can hold on to your position as these stocks can rise, as your underlying will rise, so that can give you some profit out of it. So this is the basic understanding of options buying versus options writing. Let us hear some of our market experts what they have to say about options writing. So I have captured quotations from our market experts, from our derivative market experts, from HDFC Securities, and let us hear what they have to say. So we hear Mr. Subhash Gangadharan he's a derivative expert with us, and he is saying that many investors, new or experienced alike, never consider the fact that time decay can actually work to their advantage. Whether they are bullish or bearish, it makes no difference. Those traders who choose to buy options must work hard to overcome many hurdles, including time decay and timely moves of the underlying price. In order to profit, these investors must utilize strict money management system and a disciplined approach to trading. Options writers also need to use money management and position sizing to protect themselves and their accounts. They, however, do not have to overcome the timely price movement of the underlying or volatility. Option sellers can use these hurdles to their advantage and write them to profits on a weekly or monthly basis. So that's an excellent view from Mr. Subhash Gangadharan. We would also have another expert, one of another derivative experts on the market, Mr. Nandish Shah, and let us see what Mr. Nandish Shah has to say on options writing versus options buying. So here is what he says. In the options market, 85% to 95% of the options expire worthless on the last day. Hence, option writers or sellers, they tend to make money more often and more consistently than the option buyers. The option buying is profitable only when the underlying stock price moves significantly in a short span of time in the desired direction. Moreover, if the underlying does not move in a short span of time or moves against your expected direction, the fall in option premium results into losses. The positive aspect of buying option is limited loss, which is equivalent to the premium paid, unlike in option selling where losses can be unlimited. Moreover, option buying has the potential of giving unlimited returns as compared to option selling, in which return is restricted to the premium receipt. So it is a single most important reason for retail traders to go for options buying as compared to option selling. Whether you are bullish or bearish, by creating leverage positions through buying of a call or a put option, a buyer can express his view without taking any undue risk. So if the view is proved out to be correct, he can earn higher return on his invested capital compared to other derivative instruments. Therefore, I believe that option selling is more useful for HNI and institutions who understand the risk and reward very well. As for our retail traders or beginners in the market, I would always advise for options buying rather than options selling. So this is the expert view from Mr. Nandish Shah. So thank you, Mr. Nandish, and thank you, Mr. Subhash, for giving us your expert views. Now that we have covered our expert views, I think we would also like to, we would also like to understand more on what, not just experts, but what also as a beginner, as a novice trader, or as a learner in the derivative market has to say. So here I have with me Mr. Ashish Asthana, who's joined us in many webinars. I'm sure he's a popular face amongst us. But Mr. Ashish, we've done a lot of webinars together. We've
Yes.
done pro terminals together.
True.
And you have also understood a little of the, whatever I've covered in the options. So maybe decoding derivatives or options. And you yourself are as a novice, as a beginner learner of derivatives. So Mr. Ashish, whatever I've covered, understanding options buying and options writing. So as a novice, what strategy would you prefer?
See, well, first of all, thank you so much, Soni. See, I have understood the basic concept, of options, like how to buy a call option. When you're buying a call option, you have a bullish view. When you are taking a put option, you have a bearish view. That is, quite understandable and simple and easy for anybody, right? But when we talk about selling, writing an option, that means if I'm bullish, I know that this stock is bullish and I have bullish view on it. It is quite easy and digestible. It is easy to understand also. But when it is other way around, where I'm being bearish, and then I'm short selling or writing, and then expecting a kind of a return when it falls further, it becomes sometimes complicated. So it is advisable that that you should, this concept, if you're fully aware about it, if you're writing the call option or if you're selling it before, if you're fully aware about the entire concept, then only it is advisable that you should go for it. Or else, to start up with, buying a call option is a much better option, is what I feel.
Absolutely. I think that's how all beginners and all novices must go forward. So have experience to understand what writing actually can do for you, because it may be a little complicated to understand for a novice trader. Right. So I think that's quite nice. We've had views from experts, we've had view from novices, we've had view from someone like me as well. So, but Ashish, can you also help our traders, our customers to understand that if maybe they are new in the market, or maybe they are quite an experienced trader in options as well, I think information is very important to gather. So the moment you do not have the right information, you would not know whether you have to go for a buying or writing, or what should you do exactly. So Ashish, do we have anything with us, any platform where where maybe as a novice, or maybe even a little in the experts and expertise into the this option market, where I can just calculate and have predefined option strategies for me?
Of course, yes. That is, we have our advanced trading platform, that's Pro Terminal, right? It's. I would say it's a one-stop shop for all this kind of a data what you need. No need to go on third-party websites. No need to go on exchange websites to calculate things. Here, our Pro Terminal gives. It's a platform which is, which can be useful for information-seeking customers. It can also be useful for advanced traders, right? So definitely I will be telling you how you can get benefited by using this Pro Terminal, and how you can see, as Sony said rightly just now, you have views but you need some information to support. You think that this might happen, but if you have 3 or 4 data points which supports to it, then definitely your confidence increases. So here specifically I will be talking about our strategy builder, what we have, wherein you can see health indicator is one of the thing, wherein in any stock, if stock specific information you're looking out, we have a health indicator which defines the health of the score on some 25 fundamental parameters. At the same time, if you are sure about it, you have got gathered that you can get news also in that same platform. You got the health score, you got the news, and you can see the trend which has been happening. We have 15 minutes built up strategies also. Yes, so all these things will now help me that, okay, I was being positive on this particular stock XYZ. I have got the news, I have got the health score, I can see the market momentum, what has been happening and how it has been performing to the various newses which is coming across. Now I should go with it, but I don't know what strategy to put.
Absolutely.
Right, but I'm quite sure that this particular stock is. I am very sure that it is expected to grow. Now I'm carrying a bullish view. I have a very bullish view that within 15 to 20 days this stock will rise up. But what strategy to put across is a question.
Absolutely.
So there, our strategy builder comes into the picture, wherein you simply have to put your strategy, your target price, and your target, date, and just click on strategy. Immediately, the strategy will be displayed over there along with the payoff diagram. I simply need to follow both of them. It can be buying a call option. It can be buying a put option. It can be vice versa as well. So I'll show it to you immediately how you can do that. It's very simple and easy. You simply have to log into our website, that hdfcsec.com, and click on login. Then you need to enter your login credentials, your user ID and password, followed by your date of birth, and then simply click on login. This is our empowered trading portal For Pro Terminal, you simply click here where you can find the option strategy calculator. This is a default watch list. So there are two options to get this strategy calculator. Either you can directly go here under markets, the last option as strategies, right? Or you are at any specific stock, or you are at any specific, let's take Bank Nifty. If you are on Bank Nifty or any specific stock also, let's take a specific stock, if that is just for an example. And right here you can see the strategy. The moment you click on strategy, immediately you can define your target price and your target date, and these are the filters which you can arrange it as per your requirement. If you are looking out for maximum, your first priority is minimize potential loss, your second priority is maximize profit, your third priority is maximize chances of max profitability, and your last priority is maximize return. So whatever may be your priority, you can drag and drop accordingly. And then you simply need to enter, as I feel that this particular stock by 31st or maybe by 28, it will come to say 1650. So I'll just enter my target date and my target price, and then I'll click here for strategies. The moment I click, immediately three strategies have been created: bull call spread, long strangle, and two long strangles. So in bull call spread, I can see I need to buy one. Contract which is of 31st Jan 2019 with a strike price of 1500 with the premium of 86 rupees, and then I have to short one, I have to sell one, and that is the strike price would be 1540 at 66 rupees premium, right? And here you can see that my profit as on 28 December would be 5326, and the chances are about 68%, and my maximum profit can be 7851.63. So, and here is the payoff diagram as well. So by doing this, you have made one buy wherein it has, and one sell, so you have limited your loss as well. So this kind of diagram is displayed over here, which will give you information about the same. So that's how simple and easy it is. This I've just shown you about the particular stock. Similarly, if you want to do it directly for Nifties, you just click on strategies and enter your target price, your whatever you are expecting, 1150 if you are expecting, and your date by when you are expecting, and just click on strategies. Similarly, the strategies would be created out here. Now again, it can be I have been chosen have a bullish view, that is why I have put across those things. It can be other way around. If you have a bullish view as well, that also can be possible. So bearish view, I'm sorry, if you have a bearish view, that also can be possible. You simply need to click for strategies, and immediately the strategies would be created. Think about it, and take your informed decision. All you have to do is just do this actionable. That's it.
Right. So thank you, Ashish. I think it's been quite nice for all of us to understand exactly how we can use our digital platforms and understand all these strategies front and everything.
Right.
Now I think this is all that I can say about options buying versus writing. So obviously everything obviously comes down to just the important points. One is have a view, understand your risk and reward appetite, your portfolio, your rewards, whatever you can have, and accordingly set a strategy, whether you want to go for buying an option or writing. And if you're going for writing, please be clear that you are thorough with the concept, right? So this is all that I can have for options buying. Now we're open to question and answers. Okay, how to buy this option from Empowered? I think it's the same way how you put in any trade in Empowered. It's the same way how you go log in into the Empowered, and you'll have a drop down from the equity and derivatives. You drop down from the derivatives, choose a strike option, be it a call or a put option, choose your stock, Nifty or Bank Nifty or any future stocks, and you place your order. It's same way. Now, Mr. Padman Naman is asking if Pro Terminal is only for derivative traders. Ashish, would you like to answer?
Yeah, definitely, sir. It is not only for traders. It is for any investors who is looking, because see, before you do any kind of investment, you need to, before you decide any specific stock, there are multiple questions that is there in your mind. How does this stock look like? What is the stock all about? So all this information Pro Terminal provides you. So Pro Terminal is not only for derivative trader, it is for any investor or any particular customer who is an information seeking customer or who wants to take an informed decision. In fact, we have done recently last webinar on Radar, which is a new feature which primarily focus on cash segment. So on cash segment on equities. So it is already uploaded on our YouTube channel. I request our viewers to go to YouTube and search that earlier webinar, and definitely you can take advantage. And as I said, it is there for all the customers. The only difference will be if you start trading with Pro Terminal, you will become like a pro.
Absolutely. Right now, Mr. Naresh Kamath is asking if I'm buying a call option as I'm bullish, then I square off by selling that call option as my target is achieved. So can I square off in intraday too if it is achieved? Yes, you can absolutely. If your view and your target is achieved, you can square off your position anytime you want. Is there any demo account where we can trade strategies initially before entering derivative market? There is no such trade strategies. There is no platform. There's no broker that gives you that platform to have a virtual trading. However, you can exploit a pro terminal like Mr. Ashish has already shown you these strategies. You can just go for those strategies, note it down in the Excel and see how they perform as per your view. Mr. Atish is asking, are there any charges for Pro Terminal, Ashish?
Yes, there are charges for subscribing for Pro Terminal. 3,000 rupees, 2,500 rupees is a charge, but as a part of promotion, we are providing subscription only for 1,999, so about 2,000 rupees. But still, I would suggest you to speak to your branch manager, speak to your relationship manager about the same. At various places, we have different promotions running, so it might be possible that you can get it for free of cost as well.
Thank you. Now, Mr. Mahesh is asking if we are exiting before expiry, then at the time of exit, there will be some premium. How to estimate the same before taking the trade? Okay, Mr. Mahesh, like you saw me calculate the intrinsic value of these into the of the moneyness of the options first. That would be more important for you to first calculate to understand if these strike that you've chosen has an intrinsic value or not. Next would be to understand how to calculate premiums. Now, to understand the premium, what factors that affect premium, there are a lot of factors. There's volatility that affects, there's delta, theta, a lot of Greeks that can affect. I have in details explained all of these factors in one of my previous webinars called Decoding Derivatives. I would request you to go to the Decoding Derivatives 2 and 3, especially to understand how these factors they affect options pricing and premium, and how you can understand before or after expiry where how much premium is left. So that would be a little more of the detail.
Right.
Okay, last question that we'll take is from Mr. Pradeep, who's asking, can you tell some indicators for Bank Nifty or option trading? Great, I think, Mr. Pradeep, there's a lot of indicators. I have specifically done a webinar on Bank Nifty option strategies. It is known as nitty gritty of weekly Bank Nifty. It is there in a YouTube channel. All you have to do is just go and search for HDFC Securities webinar in a YouTube channel, and you will come across all the recorded webinars we have done till date. There would be one particular webinar that I have done is known as nitty gritty of weekly Bank Nifty. I have explicitly I've explicitly covered a lot of strategies that you can do with weekly Bank Nifty options only specifically. So I request you to go through that webinar. I've covered it in details. I think that ought to help you out, right? So I think that's all, because we're running out of time. We've already extended a lot, so I think that this is where we'll end. I hope a lot of theory and basic concept has been cleared out for you when it comes to basic understanding options buying versus options writing. We would continuously keep on coming up with such webinar sessions more and more as it's possible, right? So thank you so much for joining us. Hope to see you again next webinar session. Thank you, Ashish, for joining us on today's session.
Thank you.
And thank you, everyone.
Thank you. Bye-bye.